Well, welcome to Quiver Financial's weekly financial market report, where we discuss the news topics that matter most to your portfolio and update our clients on the changes we're making as markets evolve in 2025. I'm Colby McFadden. It is June 13th, a very busy week in the news, but I'm going to focus on two things, which is tariff news with China and the Israel and Iran conflict with oil prices. You've got to see the charts. I mean, gold, silver, oil, AI stocks all going to the moon. It raises the question, is it a crowded moon? Do they stay there, or do we need to make some room by a few things falling off? You've got to see the charts. I've got a ton of stuff for you. Let's get into it. Woohoo! Yeah, it has been a busy week on June 13th. Summer's just getting started. Things are heating up all over markets, so it's become a crowded moon as gold makes a move this week after silver shooting to the moon. We've got AI stocks in the news, and then you've got Israel and Iran with oil prices spiking to the moon. And then along with that, we've got tariff news and Trump. These are all the things we're going to talk about. So let's get right into it. So in the world of oil, gold, silver, and AI stocks, like I said, all of them moving up to the moon. Is the moon getting crowded? I mean, at some point here, can everything be on the moon? So we're going to get into the charts. I'm going to show you some things there. Stocks, the tariff news between China and us. I mean, it's just, I'll get into it in the stocks. It's basically just think about this. Has it been buy the rumor, sell the news? I'm going to talk about why Wall Street does that, and I'm going to show you in the charts where equities look like they're headed for the rest of the month. When it comes to Israel and Iran, yes, it's affecting markets today. Big sell-off in the stock market, big spike up in oil prices. I'm going to show you in the charts where things could go, what opportunities exist, and is this a buy the dip opportunity, or is it a resumption of a bear market? I'll get into that with the charts. When it comes to oil and the dollar, last week I shared with you some rules around the dollar. I'm going to revisit those and show you oil charts and talk about what to do when war spikes out, right? When war comes out, tends to be dollar strength. We're going to get into that. I'm going to show you the charts because it might be contrary to some of the things you're hearing about the dollar. And then I'm going to do a very light, quick update on silver and gold, because last week we got really deep into it. I basically repeat a lot of what I said last week, but I want to update the charts so you can see what happened this week, because it's very, very interesting that gold stole the show this week while silver traded sideways. So what's next is what matters. I'm going to show you what I think what that is. So let's get right into it, because it's Friday. I want to keep this as short as possible. I'm going to start with equities because Friday, today, what is it? Is it the 13th? Friday the 13th for the stock market. I just realized that. How can I miss that? Gee whiz. All right. So yeah, it's June 13th, Friday the 13th. It's been a bad day for the stock market. Not a big deal. Hey, the stock market's been rallying since the April bottoms. We talked last week about the concept of buy the rumor, sell the news. I'm going to get into that when I get into the charts. Just to remind you, our theme around equities for 2025, when we started the year, we felt that equity markets needed to see a correction. We wanted to see it be led by technology. That's happened. We do believe that we're in stagflation, so we thought the relative strength or the sectors that would do best would be things like energy, staples, utilities. So I'm going to update you the charts on those. And we updated our equity update a couple weeks ago to say we now think that the stock market is range bound. So I'll show you in the charts what I mean by that. If we're right, it's a great opportunity for people who have cash, because you much prefer a range-bound market. So I'm going to show you that if you do have cash, what to watch for in areas that you may consider putting some of it to work. Not trading advice, not investment advice. Please, anything we talk about here, before you ever act, talk with your own advisor or call us so we can ask many more questions about the timing of things. Because when you're investing, it's not what you do, it's also how you do it, and also what you can handle in risk and time frames and all kinds of things we can get into. So right here is the stock market over the last the last year, the S&P 500. So you can see how it's been a volatile year. We had a nice rise into the election. Post that, and coming into April, we had all the tariff news that caused the big sell-off, and now we've had a bounce back. And the big question is this a bull market rally that started at the bottom of April, or does this thing fail and go all the way back down? We don't know yet. It's hard to tell. But what we do know is we do know that there's this trend line that if you traced it backwards, it goes all the way to 2023. So you can consider this like an intermediate term trend line. And we call it the bull bear line because essentially the playbook says that if you're a risk investor and you can handle the risk, then and you're into the world of buy the dip, then the rule is that as long as the market is above this trend line, then the bull market that started in 2023 is intact. Now you can see over the last 6 months, that trend has changed from momentum upward to sideways. So that's always in risk management. The first, better be careful because the momentum ended. Now, where is the momentum? Is it sideways or is it going to resume back upward? We don't know yet. So the next move in the market is going to tell us. Nonetheless, we are above this longer term bull bear line. So you're supposed to view this with a bias of, hey, the next dip is it worth buying? Okay. That's just that way the playbook works. And you got to manage this stuff day by day because you're constantly making decisions with not all the information available to you. So right here that I put up here is the red resistance line, which is near the old all-time highs. This is the chart that I showed you guys last week. I mentioned last week that what I'm watching is that there's this gap that I would like to see filled. That would be normal. And then down here in the relative strength with the light blue circle, I was mentioning that this gives me the impression that the market could be range bound for a lot. And fundamentally, it could be range bound because if you think of what's gone on between the government workers being reduced, there's been layoffs, not a lot, but more. And then you also have what's going on here in California around the ICE rates. And, you have enough factors here that it's hard for me to believe that in future earnings, we're going to give stocks multiple expansion. You might in AI or some other places, but in the overall stock market, it's hard for me to believe. So fundamentally, I think the setup is a sideways trading equity market. And I'll look for signs that could be wrong, and I'll let you know if that happens. And so that's really what I talked about last week, that everything I see here in this chart tells me of a range-bound market. And obviously with that viewpoint, the maximum pain would be, how are you wrong, is it goes up or down beyond that range. So that's what we're going to watch through June and July, is when the market pulls back. And now I'm going to update the chart. And actually, before I get there, last week I also talked about how the stagflation names, things like utilities here on the left, aerospace and defense, that they've been the leaders for the year. And that has continued. I also showed you here consumer staples or the basic needs of life, and then financials. And out of all of them, if you hit a rough market, if it is a bear market, the financials out of all four of these would probably be the one that I'd question the most. But nonetheless, stagflation means higher interest rates, lower growth. So these are the sectors that tend to do best, and they've led the year. So the market's telling us we're in stagflation. That's what we talked about last week. So now I'm going to update you to this week, what's happened in the stock market. So here back to the S&P 500. We've got our bull bear line. We've got our resistance. We talked about that this gap needs to be filled. Gaps get filled. It's just we could talk about that another time. What I want to show you today is this high, and in the RSI right here coincides with this first high, right? Okay. And now what we have happening is a situation where we've had a secondary high in price, a little bit higher, and the relative strength hasn't confirmed it. A confirm would be relative strength hits higher. So most of the time when I see this kind of pattern, and it's more dependable on a weekly chart, like a longer term chart, rather than a daily like this. But this is an early sign of, hey, that range bound concept might be right. Because when I see a chart like this, and from a technical viewpoint, I see that a gap needs to get filled, and the RSI is kind of set up this way. And then we're going into some news about, war conflicts, stuff like that. It's, it starts to make sense to be like, all right, maybe we are range bound for a few weeks. So the next tell is, where does this pullback find its footing? Does it find its footing at 5,600, 5,400? 5,200? Do we just splice through all those and keep going lower, lower, lower? I think for us to splice down below those and really crash, you got to have some really bad news, and I don't see that setup quite here. So I'm looking at this for Quiver clients and for myself from the aspect of, where's the next opportunity to put some money to work? Where's the next opportunity to reposition some of the portfolio from the aspect of, is there any underperformers that I haven't liked? Is there anything in the portfolio that's just a small fragmented holding? And do I want to get out of that and get back, put more focus on the names that have more relative strength? So as the market pulls back, those are the kinds of things that I'm going to be thinking about in evaluating portfolios is, okay, where's the places that aren't optimized? And in this decline, can I buy something that could help optimize the portfolios more? So that's why I would prefer to see a range bound market. And right now, the signs that I'm seeing is there. So what we've got to watch for is the opposite, which is, hey, you just crash down. I think that's a lower likelihood. Or do you melt up, which would be more of a likelihood, because there's still a lot of sentiment that's negative the market right now. So I could see where if the market did push above 6,000, that people have to start to chase it. I'll forewarn anybody who's too super excited. One thing I'm seeing in the market is there's a thing called a smart money and dumb money index. And what it means is that the smart money is the institutional guys. Most institutional players, most professionals, they tend to make their purchases at the end of the day, the last hour of the trading day. Retail investors and people that tend to be more emotional around their purchases tend to make their purchases early in the day. Market opens, boom, because they had a thought overnight, whatever it may be. So this is something that they've tracked for years. And over the last few months, throughout this rally, the smart money index has been trailing down, meaning that the professionals have been selling into this. And then the dumb money index has been spiking up, meaning that the retail people have been buying in. Retail might be right, okay? But history has shown us that if the professionals are stepping away and retail's stepping in, what's basically happening is the professionals are selling off to the retail people. And how you know that is maybe they get too bullish on TV, because I will tell you, on CNBC this last week, it was like, well, everything's so great until Friday, right? So just word of caution for investors around stocks. This next pullback's really going to matter. I really screwed up this chart, but what I was going to show you here is I was going to update the stagflation names. So over here that you can't see is consumer staples, and over here is utilities, and the one flashing right there in your face is aerospace and defense. As you can see, if you could see them, those three sectors continue, even in today's sell-off, to have better strength. So what's happening in these sectors is when the market goes down, they don't go down as much. When the market rises, they rise. So that's what I continue to see in the market. So what does it mean for you? Well, what it means is that the market bounce has been encouraging. 5,600, 5,400, 5,200 are the levels we're going to watch. For quiver clients, if some of those levels watch, I start to see forms of a bottom there, then it gives us a great opportunity to start to optimize the portfolio and bring in some names that have been on my watch list for a while. So the next couple months could be great opportunities for a lot of people if they're watching the right things. If you start to break below 56 or 5,400 with vigor, right, with an inclusive decline, then the April lows become the next target. I really think we're range bound. So this barbell approach that I've been taking is what I still stand by, which means that on one side of your purchase approach, you buy the stagflation names, the utility sectors, the consumer sectors, consumer staples, consumer goods, the basic needs of life, as well as aerospace and defense. Those energy should be on that radar as well, I think. So you make your dollar cost averaging into those, and then you also look at what's happening in the future in technology, because the new future in technology around AI and agentic AI also includes a lot of the Mag 7 names. So in this barbell approach, you can have some, very cash flow positive businesses like utilities and energy and such like. And then on the other side, you can have some of the old and new tech that's all wrapping their arms around this thing that's called AI. So that's the approach that we've been taking in the portfolios, and a range-bound market would really help us be able to deploy the rest of it that way. So this week, we put out a publication in our Next Wave blog. So on our blog, we have a few of them. One's called Catch the Next Wave. We put out a whole piece about AI investment opportunities. This is not advice. It's just basically we gave you the names. So in the world of agentic AI, how you can think of that is agent is like, for my clients, I act as your agent in essence. So if you have an agentic AI, that means the technology of AI is operating as your agent. So it's the way that you can use AI to do daily tasks, and it's getting you, coding, whatever you want to call it. So there's a million uses for it. In the play of this, there's all kinds of companies that go from Amazon, Google, Microsoft, all the way down to companies you've never heard of that are upstarts, because in the inner workings of this, you have chips and you have data and you have storage. You have a whole industry that's scaling incredibly fast. And that's why the market's actually kind of held up. This is kind of the .com. In 1998, 1999, 2000, we had the .com era and all the names around that. This is a similar situation where you have a new emerging technology that is shifting the productivity of the world. It's like another industrial revolution. So this article talks about the names that should be on your radar. All right. Let's move into the oil story, because that's the big story of the week. Israel, Iran clashing because of nuclear situations. What do they call it? Not refinement, but when they have to get the uranium ready for nuclear. So here we have bombs flying back and forth, oil prices spiking. Last week, I gave you some education around the dollar, because all these things come together, because currency trends, they're long in nature, I talked about, and then they also tie into how commodities, because the dollar is the dog that wags the tail of commodity prices. So usually, not always, but usually a strong dollar means weaker commodity prices, and a weaker dollar, stronger commodity prices. There's times that doesn't always happen, but over longer trends, that's what people tend to expect. when it comes to interest rates, like the 10-year treasury and the dollar, they tend to move in tandem. And again, not always. And the reason I highlighted that is because when it comes to war or a massive quick flight to safety. So what is flight to safety? Flight to safety is investors say, oh shit, I'm running for the hills. I'm going to put my money in the safest things possible. And what those safest things usually are in a quick move is going to be the US dollar, US Treasury bonds, and gold, right? Metals, precious metals. So that tends to be where if there's a shock to the system, you'll see those. So that's when you could have a situation where the dollar rises and interest rates go down because what's happening is people are buying the dollar, people are buying treasury bonds. They're all doing it all once as a safety trade. And so this could be one of those times that this rule derails for a few weeks or for a few months. So I just brought that up because we talked about this last week, and what we're experiencing today and what we may experience next week is a great example of an exception to this rule. So I wanted to bring it up. Let's show you a chart. This is the chart I showed you last week of the dollar. And it's a long-term chart over the last 5 years. Basically, what I'm showing you is how the dollar, even though in the press over the last month, 2-3 months, you've heard a lot about the dollar demise and the dollar's crashing and it's going lower and blah, 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 blah. Buy bullets, butterfingers. Yeah. Well, when you look at the dollar over a longer, more pragmatic, zoomed out view, you see something a little bit different because what you find is that after basically 7-8 months of decline, the dollar finds itself resting on two major levels of support. One that's horizontal, that's gone sideways since 2022, and another that's a rising trend line that's gone on really since 2017, beyond that, right? 16, 17. So when I see this, then and the news has gotten so negative on the dollar. If your goal as an investor is to buy low, sell high, how you buy low is everybody's talking bad about it, right? Because if it's at a high price, everybody loves it. It's beautiful. But in this situation, everybody's talking, throwing shade on the dollar, and it's been going down for 7 months. So I think with all this going on, people should start to wrap their mind around that maybe the dollar could bottom here because it's already been going down and the sentiment has gotten so negative. So what I did here is I zoomed the dollar down to 1 year. We went from 5 years to 1 year, and it looks like a pretty crappy chart because you can just see it looks like we're skimming like a rock across a lake here. When I see this, there is some productive things that are happening, like the RSI looks like it's stair-stepping. So the next tell on the dollar is really, can this low hold? And maybe the Israel-Iran situation is one way the dollar holds because all of a sudden there's a flight to safety, people buying the dollar because of the war situation or fear of. And so maybe this gives the dollar a little bit of a bounce here. I would not be shocked to see the dollar do one more little undercut. Sometimes these patterns, you kind of bounce on support and you have to undercut it to kind of take out the stop orders here. And then, everybody gets real negative, and that's when you get to bounce back. So what I'm going to watch for next week is what happens with the dollar. Does it can it get above 27.50 on this UUP? Or does it break below 27? Because if it breaks below 27, I would expect maybe you get a spike up in metals. And that might be a great opportunity if you've been like us holding metals for a long time to reduce or take some profits. So what's been and I'm going to get to some metal charts in a second, but here's a chart of oil, and you can see that, holy cow, straight to the moon, right? To the moon, Alice. This is the move that happened since the start of April, but this is what's happened this week. So it's been a heck of a move. I think it was like 7 or 8% in one day, followed by, in the previous day was another handful of percent. All this based on the fear of what's going on between Israel and Iran. And could they close the Strait of Hormuz? Probably won't happen. So the question here is what happens next, right? So what I zoomed out here is here's a price of oil. Here's oil prices over the last 5 years. And when you look at it there, like right here, you see that big spike. But when you zoom out, you kind of see a different picture where in the oil markets, you've had this long-term support, right? That's been there since 2022, since we got out of the pandemic. And every time we come down to that level, we seem to find a reason to bounce. And then you have this resistance up here. And this is how economies stay in trim, because if you can keep interest rates in a range, and we've talked about that to death in previous episodes, but if you can keep interest rates in a range and keep oil and fuel prices in a predictable range, then you can manage an economy like the U.S. pretty damn well. And that's basically what's happened. So based on this, I would expect with oil prices that the news continues, that this gets played out for a week or two or so. There will be an end. What that end is and when, I don't know. But the normal consideration would be that, hey, you probably have long-term resistance. That's the target up there. And to get above long-term resistance, I would think, that if this Middle East, if there's escalation in the Middle East, like they hit the little island that produces most of the oil that Iran produces, or if they close the Strait of Hormuz, if those two things happen, okay, then maybe oil prices get over $100 a barrel. Our belief is that oil prices, regardless of all the environmental movements that have happened over the years, which are getting dialed back, that oil is long-term on a rise over 3, 4, 5 years. There's a lot of reasons. I'll probably do a show just around that pretty soon, because it'll make sense now that there's been a lot of developments around a lot of different things that of why oil could go higher. So we'll do that in the future. So what does all that mean for you if you're a Quiver client? Well, the next low in the dollar, if there's this undercut that I showed you in the charts, that could be kind of like a good solid low for the dollar, and it might be an intermediate term high in metals. Metals have been going up for a while. So if you're just getting involved in buying gold and silver, know you're very late to the show. So you should be very, very careful. Okay. So metals have been moving. They don't, trees don't go to the sky forever. You got to prune them. So if the dollar has a little undercut, or there's more fear around the war, you could see a spike higher in gold and silver. I think I would use that as an opportunity to take some profits. Also, continued conflict in the Middle East is obviously positive. Energy sector. So that was a sector that was doing great into April. It went from being the best performing sector for 2025 to the worst within a month. And now it's back to being the best. Just widowmaker. If you're like total bipolar market to be able to do that. Very cruel, very, very mean. So equity volatility is probably going to maintain here. And so I would think the equity market is range bound. Which means you can take advantage of that if you have a buy list. So I want to wrap up and end things with a quick note on gold and metals, because this was an interesting week, because the last 2 weeks, silver has taken the show. Silver, since the start of June, has just gone straight to the moon. That's why I say moon's getting crowded. And that move right there is just a squeeze. I wanted to see this week if we could kind of base sideways. Last week, I also showed you the silver miners moved with it. So these are the charts from last week. This week, you can see that silver has basically just based. You can see here that since our last show, we've just based sideways. And while that's happened, and what I think is happening, this looks like one of those kind of pendant or bases
that you could get a spike out of there. Again, not trading advice, because if there is a spike out of this, you're closer to a top than a bottom when you're talking like maybe for the year. If you're talking 10 or 20 years out, the different story. But in the near term, if you've been in silver or gold or you're in it for a trade, if you do get a spike higher, at least for me and Quiver clients, that's probably a place we'll start to take some of our profits. Gold was this week was the winner. You can see that after a few weeks of basing, or a month and a half, 2 months of basing sideways, and creating this little pendant that we showed last week, that you've now broken out this week. So it seems like the market didn't have enough gas in the tank to push both gold and silver higher at the same time. So that's interesting. That tells you that there's some liquidity issues going on in markets, because with all this fear going on, if markets had a lot of liquidity to them, you would think both these would move. So that's something to think about. This is the gold chart, long-term kind of reversion to the mean trend line. And then there's this uber bull line that's now really developed over here. And this started basically in January. And the rule is as long as this trend line holds, you hold your position. This looks like it wants to break out and spike higher. You could backfill a little before that happens. But that looks productive if you're a trader and you know how to manage your risk. And again, not advice. Call me if you're interested in doing that, and I'll kind of give you the parameters of whether you can or can't. What does it all mean for most people and Quiver clients? It means that, if you're a gold trader or you're just kind of looking for a quick trade, there's another scalp coming here, it looks like. So if you're a scalper, which none of my clients are, but if you're out there if you stumbled upon the channel, and there you go. If you're an investor, same thing. I'd be careful up here. You better be a very long-term investor if you're starting a position up here. Silver, we said, was it base? It looks like it's basing for a move here. Whether that's a scalp up or scalp down is up to you to decide. But based on where interest rates are, where the dollar is, if we get a spike higher in metals, I'm probably going to use that for the Quiver clients for us to reduce some exposure there, because I'd like some of the cash to go out and buy some other stuff that looks like this, setting up for some good buys. So that's basically, wrap up here is prudent investors around. We didn't talk about interest rates because not much has happened the interest rates have behaved nicely this week. We'll get back into that conversation in a couple weeks. So, no change from what I said last week when it comes to interest rates. Stocks, range bound is what the idea is here. Maximum pain is if the market started to, push higher, because then we'd have to chase it. But if we stay in a range bound market, which it looks like to my eyes, then we can keep deploying this barbell approach, and it'll help us have a good back half of the year. When it comes to metals, based on what I'm seeing in the dollars charts, I'd be planning a selling process if I was trying to take profits. That's what we'll be doing. If you're real long-term investor, then maybe not worry about it. But that's the wrap up for that. Make sure and check out the next wave publication we put out on Agentic AI. I tried to write it as dumbed down as possible so any average Joe could read it and get a basic understanding. And it's also written kind of light and humorous too. So I'll do another deeper dive into this in next week. That's going to be more technical, and probably written for more younger people with more technicality to it. But nonetheless, check it out. And until next week, I think I'm going to take next week off because I got some visitors. So until the end of June, take care of yourself. Have some fun during summer. Hopefully you guys are getting some vacations in. And have a great Father's Day to all those fathers out there. I'm going to enjoy it with my grandkids. Take care, everybody.